Hi, this is Ron Janish over at andrewscourse.com, and as many of you may know, I personally teach the Andrews course, and this here is my friend Dr. Alan Andrews, who taught me these techniques in the comfort of his home in seminars that were given in Florida, and in some cases it was through his instruction in his written material. I'm lucky that I have in my possession the massive expanded library of Andrew's material, which is close to 1,000 pages. And those are all original Andrews things. And one of the things that I found in going through those things is that what Andrews would do is he would actually rate trades. And by rating trades or turns, let's say he would rate turns, he was able to handle um, situations where the market was very choppy. And let me show you how that works and give you a sense of that. Let's see, where are we? Here we go. Okay. This is a chart of the S&P. And on here we have a lagging indicator. And this lagging indicator is known as this is the 50-day moving average, and this other lagging indicator here is the 200-day moving average. And the reason I put it up here is because this is what some people use in order to have a sense of the trend in the market, and there are some that believe that this is 80% reliable. Okay. In other words, when the 50-day moving average goes above the 200-day moving average, the theory, according to them, is that the market is going up. And when this goes below it, like it did over here, for example, the theory is that the market is going down. The problem with lagging indicators is they are lagging. And so what happens is that while, yeah, the market does seem to go down quite a ways here, if somebody goes short here and long here, this is not a winning situation. And this may be one of the losses that occur with this kind of a pattern, whereas you can see here, if it went long here and got out here, it might be some kind of a winner. So what we're looking at here is how one can combine leading and lagging indicators, and also how Andrews would handle whipsaws and whipsaw situations. And here's a really, really good example of a whipsaw situation. As you can see, there's lots of R's on the chart here, R1, 2, 7, and stuff like that. Let me give some meaning to these R's. These R points here are points where we publicly went and said there's an ORE here. Now, and this isn't just, me shouting it to the universe. This was where we published it in the open email group, or published it on CNN or on WordPress, things like that. So it's boom, it's out there. And if you notice, what we did was we labeled all of them, and in this particular situation here, we really started looking for all these little points, and we noted that if you use the Andrews rating methodology, you can have a pretty good idea as to what kind of strength the next move will have. In other words, if this here is an R1, then you're looking for something that lasts several days. And in this case here is nicely reversed by an R6. So here you had an R1, R1, and here you had an R7. With an R7, you can see that from an R7 going out into the future, there are several higher points. Just like here's an R4, and this comes at the end of this move, and there are a multitude of higher values. Just like here, there's an R3, here there's an R6, and after an R6 or after an R7, there is usually a very nice move. Now, sometimes this move can be rather choppy with a whole bunch of R1s in between. R1 is nothing more than an OR, the Andrews OR indicator, which is a reaction line, a Babson type reaction line that Andrews considered the most accurate in terms of finding the extreme of the move. So if you find these, these OR type situations here, it's always a good idea to know what the rating on it is. And this is something that's discussed in the videos that we give to our course members. So, as you can see here, here was an R7. Now, if, for example, if this was May 1st, and if you look back on CNN iReport, we posted May 1st as an important major top in the Dow. And the reason we're able to say major top rather than turned it at an OR point is because this one was rated a 7. Okay? So here you had your rating of a 6, and notice that after you get a rating of 3 or more, typically there's a really nice move. Whereas when you have a rating of only a 1, there's a small move. Now, how this can be useful in conjunction with a lagging indicator is as an exit, for example. If you use a lagging indicator to get in the market, so let's say you got in because of this move here, when you see any kind of situation with an R rating of 5 or even 3 or more, you probably want to exit totally and look for another time to get in. So here, while your lagging indicator was pointing down, up here gave you a really nice additional entry point. And so once again, you have a rating down here of 3, and this gave you a nice place to take profits. And so once again, prices come up to that 200-day moving average and reverse just like they did here. And once they hit down at the R6, that's the end of it. So the question may come up, if this was an R6, was this an R3, 4, 5 in between here? And the answer is no. And so what happens after an R6 is if you went short because of a lagging indicator like here, and then prices went down, and you took your profits here, after they went up, you probably went long with this lagging indicator after they did their cross of the 50-day over the 200-day. And after you see that you have an ORE up here, which is rated 7, you know that it's a good time to get out. Right? And as you can see, when you have an R4 down here, and your lagging indicators are positive, meaning the 50-day moving average is over the 200-day, this would be a good time to possibly reinitiate your long position, knowing that whenever you get an R1, the probability of a reversal, be it temporary for a few days, is pretty good. And so here you have an R7, And so here you have another wonderful opportunity to take a trade with the lagging indicator trend. Okay. So I hope this gives you an idea about combining lagging and leading indicators. It gives you an idea about how to handle choppy markets, and makes you a better trader. So I thank you for your time, and when you get a chance, go over to andrewscourse.com, click on products, and when you order the Andrews course, which consists of a whole slew of videos, membership in a private email group where when I send out emails, it's not uncommon to have the R rating on there. And R just, that's just the reversal rating. Okay. And to make sure that I get you that special video that goes into great detail on the R rating, on that reversal rating, just send me an email after you take the course, okay? And I'll get that to you. Anyway, I thank you for your time. Bye.